bonds, preferred stock, and common stock. What's the difference, and how do you choose the right one for your investment strategy? We'll have Cash and Crow, DKI intern from the University of Tennessee, break down risk, return, and what gets paid out first if a company goes under. At the end, you'll know exactly where you stand in the capital structure and how to align your portfolio with your risk tolerance.
Moving on to the final thing of this week's version, the tariffs for one issue. We're talking bonds, preferred stock, common stock. We're going to introduce Cash and Crow here, DKI's newest intern. Cash, and what do we kind of need to know just at a high level about these three items here?
Yeah, so these three items are basically the main three ways that a company raises equity or debt. So it's the main three categories of a company's capital structure. And it's really important to understand the difference between them when it comes to your risk tolerance and how you want to try and profit from a business's success.
Awesome. Let's start cashing with corporate bonds. Tell us a little bit more. What does maybe a beginner, intermediate investor need to know about corporate bonds?
Yeah, of course. So a corporate bond, like your average bond, but with a company, is going to be a loan to this company in exchange for a promise to receive that money back in the future, and you're able to receive interest payments on that loan at a specified coupon payment. And corporate bonds, the risk is the lowest out of these three, but income is also the lowest. So it's really good for an investor who wants steady, predictable income. And it's not a slice of ownership in the company, and you don't receive dividends, voting rights. Sorry.
No worries.
So yeah, you don't receive ownership or voting rights in the company, but overall, it is a steady, predictable income. And basically, the only downside of corporate bonds is that a lot of times inflation can make your return a little bit lower than what you hoped for in the future.
Let's move cashing now into preferred stocks. So obviously with corporate bonds have a little bit of a lower risk. Tell us kind of differences with preferred stock, or what investors need to know about what a preferred stock is and how it works.
Yeah, so moving on from debt to equity security, preferred stock is an equity security, but a lot of people like to think of it as a hybrid between an equity security and debt because the risk is still relatively low, but there are opportunities for a little bit of higher income. And with preferred stock, the way an investor makes money is on dividend payments based on a percentage of the par value. So it is still predictable income. It's steady, but the risk is a little higher, which gives you a little bit higher chance for income. So overall, you do have ownership in the company this time, but you're still not receiving any sort of voting rights. And the main downside of preferred stock is, I meant to say just the main thing about preferred stock is that a lot of times these issuances can be converted into common stock at a predetermined ratio.
That's right. Yeah. So speaking of common stock cash-in, I think that's probably what beginner investors are most familiar with, right? When we see things trading on the market. But tell us more about common stock and what to look out for there.
Yeah, of course. So common stock is your most average equity security. And a lot of investors choose this because there is an unlimited upside potential. So you do have a lot more risk, even though you have limited liability, there is a lot more risk than the other two, but you're able to receive profit sharing in the form of an increase in share price. So with common stock, you have both ownership and typically voting rights. However, the only caveat with those voting rights is that sometimes they are diluted with super voting share classes owned by management and founders of the company. But overall, investors choose common stock because they have the highest upside potential, and they're really good for investors seeking long-term capital appreciation.
Great breakdown there, Cashin. So yeah, I think you got kind of the spectrum of risk there, different hybrid types of stocks when we're talking about corporate bonds, preferred stock, and common stock. Cashin, to close it out, Let's say there is a bankruptcy. You know, we talked a little bit about liquidation in the written version of the 5 things, but what happens with each of these, the bonds, the different types of stock in the event of a bankruptcy liquidation?
Yeah, so this is something really important to take into account when investing into one of these three. And it's that when a company goes bankrupt, what they're going to do is take their assets and sell them off in order to repay these debt and equity holders. And they do so in a specific order. So first you have corporate bondholders, then preferred stock, and then anything left over would go to the common stockholders. And this is, important to take into account because if you're investing, let's say, into a company that's got a lot of debt, you really want to pay attention to their balance sheet. If they don't have a lot of assets off to pay off that debt, then investing into something like common stock at the bottom of that capital structure is going to be your most risky option because you are the least likely to be paid back off of your initial investment.
Excellent stuff, Cashin. Thanks so much. Cashin, why don't you give a little background for everybody listening, just about you, what you're working on, where you're going to school. I know Gary mentioned at University of Tennessee, but if you want to do a quick intro for everybody.
Yeah, of course. So, my name's Cashin. I'm a freshman at the University of Tennessee in Knoxville. I'm majoring in finance and accounting. And yeah, that's about it. I just joined with DKI here about a month and a half ago, and it's going great so far.
Awesome. One fun fact about you.
I love typing.
Typing?
Yeah, I love
All
typing.
right.
I did not see that coming.
I'd say on average probably about 95. So
Whoa.
it's pretty good. It's not great, but
that's pretty good. That's pretty good. That's pretty good. Well done, Cashin. And yeah, Cashin has been awesome working directly into deep knowledge investing. I know working right alongside with Gary and adding tons of value. And thanks so much for all your contributions to the 5 things. A lot of work going on behind the scenes to produce not only this segment, but also the written version of the 5 things on a week by week basis to keep you in the know about everything you need to know in investing for the week.